The Fed has overstepped most of its boundaries really since '08. This is the message from my guest today. She is a best-selling author, an investigative journalist. She was also a former managing director over at Goldman Sachs. Nomi Prins is the best-selling author of Collusion: How Central Banks Rigged the World. Nomi, I've been following your work for years. I don't know how we haven't connected before, but welcome to the show.
Thank you so much. And I know we've been trying to connect over those years, and I absolutely appreciate your following. And I'm so glad, at least over Zoom now, we get to
Yes.
have this connection.
Absolutely. And we have a lot of ground to cover here. You've been very critical of the Fed, saying they have overstepped most of their boundaries from '08, and it's under the guise of, wanting to help the economy. But, the money printing they're creating is not going to the real people.
That's right. And it really hasn't been going to the real people for a couple of reasons. One, that was never the Fed's actual job. When the Fed was created back in 1913, the idea was it would help to funnel liquidity into the system, i.e. get it out of Wall Street across the country. That was what was sold to Congress and to the American people, and that wasn't the case. It was really the bankers that wanted emergency sources for themselves, and that's ultimately the Fed's best sort of focus for the bankers. Now, for the actual Main Street individuals, the money that the Fed creates, the rates that are at 0% under their current monetary policy and their monetary policy since the financial crisis of 2008, and their quantitative easing or bond buying policy, and they buy these bonds from the banks, really serves to deflate the value of money, to allow banks to basically encourage this moral hazard relationship for themselves with the Fed, and ultimately propels markets up, but not the real economy. And we can see this in all of the data from 2008 through this pandemic period. However you slice it, the increase in the level of stock and the equity markets is by far greater than the increase in the growth of the real economy by any metric.
Absolutely, absolutely. So if we're living in this world and we are a Fed gone wild, can it be tamed? How do you bring them back? Can it happen?
I don't see it happening in the near term. We know for a fact that the Fed has gone on record as admitting that until at least 2023, rates will continue to be at 0%. Now, rates have effectively been almost at 0% since 2008. We had a little bit of a bounce up for a minute, but basically we're back down to that level, and there's no expectation from either the Fed or certainly from those of us who are watching the actual balance sheet of the Fed, to assume that's going to change anytime soon, certainly not in the next few years. In terms of quantitative easing or bond buying, they started back in the financial crisis buying treasury bonds and buying mortgage-backed securities from the same banks that created bond mortgage-backed securities that created the crisis. And now they kind of added corporates to that mix, but they've expanded their purview of what they can buy if they deem it's necessary to buy it, and what they call their toolkit of whatever is available to them to ostensibly help the economy. As long as they have that mission that they articulate, whether it is actually coming to fruition or not, they are going to keep doing what they are doing. And the leaders of the Fed, the appointed board of governors of the Fed, continue to buy into this idea that what they are doing is the only policy that they can follow.
With Janet Yellen in the White House, does their toolbox become even more expansive?
I think so, yes, for a number of reasons. One, under Janet Yellen, who basically took the torch from Ben Bernanke and then gave it, or it went afterwards to Jerome Powell, who's now the chair of the Fed, the same policy was really followed. There was a couple years in there under Janet Yellen where rates went up by 25 basis points in 2015, by 25 basis points in 2016, and a little bit more towards the end of her term into Powell. But the reality is she is a supporter of that type of monetary policy. She's not going to change her mind because she's Treasury Secretary. She's going to continue to support that policy of incredibly loose monetary policy. And also, she's in favor of deregulation in her core, from the standpoint of when she was an economic advisor under the Clinton administration. I mean, she has a history of saying she supports Main Street and possibly wanting to in her heart, but in actuality, perpetuating policies that put Main Street at risk and also keep this level of money artificially cheap.
Interesting. In one of your latest articles, Nomi, you write about this financial war of the worlds we're living in, the chaos we're living in. You compare it to, H.G. Wells' The War of the Worlds. Instead of a Martian attack, though, it's another type of attack. What are the best ways that investors can protect themselves in this environment? What are the safe havens for you?
Yeah, so the key way that investors can protect themselves, and I did equate it to War of the Worlds, that was going over a period of time where H.G. Wells wrote The Industrial Revolution, and then there was the War of the Worlds sort of public radio show, which freaked people out in 1938 at the depths of the Depression era. And so there's this fear that was coming into people from the standpoint of Martians. I look at it as a standpoint today of this financial disconnect between what's going on in markets and the people sort of in the know, and the larger investors and the richer individuals versus everybody else. And everybody else is not in that environment. So there's a couple of things. One, absolutely, I think it's important. It was important like yesterday and last year for individuals to educate themselves as to how the market works and what investments to them are available, not just stand out because they are disenfranchised from the get-go. Actually kind of move in a little bit into the markets and into certain investments that can preserve and protect their wealth and that have use value to them. So for example, in the precious metals sector, I believe that there are certain precious metals, there's gold, there's silver, there's copper, that have different components of their value. Gold has historically been considered to have a wealth storage component, but it also has a use component. Silver has a larger use component. It's instrumental in sort of the new types of batteries and electric vehicles and the sorts of things that are going to be real economic staples going forward and real uses that they're going to have for individuals. Same thing with copper, the wiring and those sorts of new types of sustainable energy or green energy or electric vehicle type of products. All of that is going to give this additional, very new post-War of the Worlds use value to these types of things. So I think that's a good thing. I think same thing sectoral-wise. There are things to look at in futuristic sectors that will ultimately have some real economic benefit. So marrying the two, elements that store wealth, precious metals, sectors like sustainable energy, sectors like technology in healthcare, which we so desperately need more of, 5G technology, the things that marry the two, I think are going to be places where investors should look.
Nomi, I got to ask you because you come from the world of Wall Street. You were at Goldman Sachs. That's traditionally seen as not a place that embraces precious metals. Were you a lone wolf with that approach? I know that it's no longer the world you belong to, but did you feel alone in embracing precious metals?
A little bit, and real quick story. When I was writing All the President's Bankers before collusion, one of the things I looked into was the Nixon era and the sort of leaving the gold standard that he pressed the states in. And actually, it was the bankers that had pressed Nixon, which is a little known story. I looked at it deeply for my book, but they pushed him, and the reason for that was so that the United States and the bankers could have more influence over the money that they use. So over the dollar, over the Federal Reserve's ability to create money, because you can't create gold. And so there was a whole idea prevalent for decades, really, in the banking community that gold was a restrictive just thing on their general ability to grow their presence. And indeed it was, right? Reducing the reliance on gold or the gold standard completely allowed banks to really gain in power and influence, in the same thing with respect to the Federal Reserve over the decades that followed, not immediately. And so I think there's an intrinsic sort of displeasure with the idea of supporting precious metals. That said, Wall Street is also a very flexible animal. And to the extent that today there actually is more interest in precious metals and in these use values, and particularly of certain precious metals like silver and copper, Wall Street is not immune to the idea of investing or being involved in investments that push their profitability forward. And I think as a result, they're actually kind of coming into this space, which will give it lift as well.
I agree with that. Having worked on Wall Street the past, now 10 years, I would have to say I've seen this shift and greater embracement now of gold. Just a final thought, Nomi, I know a lot of your work involves sometimes really coming down harsh on the banks. I want to get your take on how HSBC is reacting to Bitcoin. They're saying no to Bitcoin, basically. Is this a trend we're going to be seeing?
I think so, because again, of this, like with gold, this idea that banks do want to control their own financial environment. I mean, they've spent, decades, centuries, components of centuries developing some of their footprints, depending on the institution. HSBC is a very long-standing institution, so is JP Morgan, and so forth. And as a result, they want to be very careful with allowing that fund flow to be outside of what they can control. But again, as I said before, ultimately, with respect to something like Bitcoin, to the extent that it becomes more prevalent, not simply as a speculative or an investment asset class, which I believe it still is right now, but if it sort of goes beyond into the next step of greater use value to people who can't afford to lose money in the investments that they could potentially make in the volatility of Bitcoin that we have now, I think banks will turn around and have to embrace it. And another thing that's happening with banks right now is they are looking for more technological platforms to compete with things like Cash App, like PayPal, which will have to also look at different modes of moving funds around in different forms of money. And I think ultimately, again, that profit incentive beyond the control desire will come forward.
Nomi, Prins, best-selling author of Collusion, some really brilliant stuff. I encourage everyone to follow your work, Nomi. I'm happy we finally got to do this. You're welcome back anytime on the show.
Awesome. Thank you so much.
And thank you all for watching. We'll have much more fantastic content, so be sure to stay tuned to Stansberry Research. In the meantime, keep following us on all our social media platforms. Thanks for watching. I'm Daniela Cambone.